Welcome to the Professional Investment Podcast. I'm Charlotte Moore, award-winning journalist and founder of Moore Squared Communications. Each episode, we welcome a guest to the show to share their news story of the week. And this week, I'm delighted to welcome Simon True, CEO of Clara-Pensions. Welcome to the show, Simon.
Hello, Charlotte. I'm delighted to be with you on this show.
Lovely to have you on the show. Do tell us, Simon, what is your news story of the week?
So my news story of the week is Donald Trump piles pressure on Federal Reserve Chair Jay Powell to cut interest rates. And that was in the FT on the 23rd of January.
Yeah, it's a great story. There's plenty that seems to be playing out at the moment. Seems to be like there would be a battle brewing between Trump, the Federal Reserve and the markets, with everyone having a slightly different view on the direction of interest rates. And we've also seen lots of things happening on this side of the pond with UK interest rates rising as concerns mount about Rachel Reeves' economic plans for the UK. I mean, interest rates have really been the story of the last few years, and they've had huge implications for pensions. What's your take on what these ongoing interest rate shenanigans is going to have for UK pensions?
Well, let's deal with the word shenanigans first, shall we? I don't think that where we are today is anything like the shenanigans that we had in September 2023. And, you know, it's a very short time ago. It's sort of hard to believe that it was only less than 18 months ago that we had that, you know, huge market shock. It's important to put in context where we are today with that event, because what happened over that period, very short period where interest rates rose very, very sharply, as did inflation, that it had a huge impact on the pension scheme environment. And that's important for a few reasons. Number one, I think it exposed to people that, you know, a lot of faith was in liability-driven investments. So just to explain for those not familiar with it, a lot of pension schemes take this out. This effectively hedges to a large extent that their liabilities move in line with the changes in assets that support them. And that's really important. But what happened during that period of sharp increase in interest rates was that effectively it showed that they weren't perfect hedges. And secondly, in extreme situations, that you required a lot of liquidity to provide the collateral for it. And that was obviously a very sobering event for a lot of people involved with pensions. What it meant, though, is that was, to some people, it was a bonus as well, because effectively these interest rate rises led to the liabilities being discounted at a high rate. And actually, effectively, people were much closer then to buy out or alternative options that they could remove the liabilities from their balance sheets. So it was a huge beneficial, albeit slightly scary moment for people. But what we have today is slightly different. There's been an inexorable rise in interest rates, but people have seen it coming. And to some extent, that more gradual rise hasn't exposed deficiencies in the LDI world that we've seen before. And notwithstanding that, a lot of people have changed the way that they do hedge their positions. So net, I think if you take into account that one-off event and then the increasing rises, you've got a situation where a lot of pension schemes are relatively well funded, and that gives them a range of options. You have a lot of people close to buyout, which for, you know, probably still for the majority of schemes, that's still the gold standard. You know, effectively securing members' benefits in the insurance market is still a great thing to achieve. Actually, some people have blitzed through that point and are now contemplating whether they can actually run on the scheme and use the proceeds elsewhere. And for some people, they will be looking to Clara as a consolidator as another option for them.
I'm so glad you brought up hedging and that the hedges weren't perfect, because he goes, I can use this. My favorite saying about one of my favorites anyway, financial markets, the perfect hedge only exists in a Japanese garden. Nerdy, geeky financial jokes. You've got to come to the Professional Investment Podcast for it all. We know how to have a good time here.
And that was not teed up at all.
No, it wasn't unscripted and very spontaneous. But yes, I mean, you've explained that situation well, and there was a lot of sort of beating of chests and rending of shirts at the time. But LDI did do what it was supposed to do, and the reality is that we now have a much improved funding position in pension schemes. And I think sometimes we forget actually just what a dramatic turnaround it is for closed DB schemes when we've had 2 decades of people worrying about how am I going to get my funding levels to meet those liabilities that I have to pay. And now we're in that privileged position of thinking about, well, maybe I'll do buyout, maybe I'll do run-on. But I think that can be different for different pension schemes. Have quite a lot of conversations in the industry around this. And the options look different given the size of the scheme and the strength of the covenant sponsor. To bring it back to what you at Clara-Pensions is doing, which is aiming to consolidate those smaller closed DB schemes, how does it change that equation for you? Does it make life easier or harder?
So taking just a step back, Clara is a bridge to buyout. We're the member first consolidator, so we focus very much on making sure that any consolidation is clearly in members' interests. And to do that, we generally look after schemes for a period of typically 7 years, and then we take them through into buyout. Each section that comes into Clara is supported by its own unique capital, ring-fenced, and it's new capital. You're not recycling other capital, bring some new capital in to support member benefits. So a demonstrable improvement in member security on day one. Now, in terms of what's happened to the landscape and what's the argument for consolidation? I mean, consolidation, crudely isn't very difficult to get your head around. Having larger, well-run schemes, we ought to deliver lower administration costs. We ought to be able to deliver lower governance costs, improved governance, and crucially, from your aspect, on the investment side, well, we can actually apply investment expertise across a deeper pool of assets. And secondly, as you get to a critical mass in those asset sizes, we can access asset classes that smaller pension schemes would not be able to access. They wouldn't have the expertise nor the scale to do so. And if we can utilize and harness those economies of scale, and then effectively offer attractive pricing to trustees so that they can secure their members' benefits with Clara, then we think that's a good outcome for members. And so, in terms of what does this mean into increasing interest rates? Well, the increasing interest rates in 2023 basically made it was a tough day at the office. I'm not going to lie, Janet. A lot of people we've been talking to for a long period about being a bridge to buyout found themselves the next day able to afford buyout. So we weren't able to provide a demonstrable improvement in their member outcomes. It didn't make the model wrong. It just meant that we've been talking to the wrong people. And so it reset the market. And since then, we've been talking to a different group of people. And you will have seen that we've done 3 transactions to date. We've got around £1.5 billion of assets under management, 21,000 members. So we've managed to make progress post that reset in the market. What we have done in the meantime is work with schemes from a lot longer out. So going back to your bonsai example, hedging earlier, getting people to hedge into the Clara position so that they got certainty that although it can take them a while to get their heads around it, they can lock into the Clara solution. And actually, it's an interesting point about how many of those schemes who sort of lucked out a little bit, if you like, with improved funding. What we don't have visibility on is how many of those schemes have really locked it in. Have they actually made sure that that surplus wasn't intangible but still exists 18 months down the track?
And by making in terms of locking in, you mean putting the necessary hedging in place so that they get rid of that volatility of the liability position, and so they can know that that is their funding position and it's set in stone-ish, given that the perfect hedge only exists in the Japanese garden.
Exactly right. And so if their desired outcome is buyout, they really need to lock into effectively a buyout to try and match to where buyout pricing will go. If they're working with Clara, try and lock into our asset mix, which is relatively easy to do in the sense that we've got a very vanilla asset strategy. We're typically around 30% LDI, about 35% liquid credit, and the remainder in illiquid credit. That's relatively easy to replicate depending on the term of the liabilities of the scheme. So
talk to us a bit more then. We've sort of touched on your asset allocation there. Talk to us a bit more about the investment opportunities, and whether are there sort of milestones of assets under management that you think of, where things become sort of like a video game, next asset allocation unlocked? Because it sounds quite similar to the discussions I was having with Joe around DC schemes and master trusts. As they get bigger, we've seen with people pensions, as they've approached 30 billion, they're now thinking of private assets. So do you have kind of a rough sort of plan in mind as we get to, say, from 1.5 to 5 billion and then to 10, maybe 15, 20? Can you give us an idea of what you would be doing differently in those different asset sizes?
Yeah, happy to. So when you're relatively small, it's basically liquid credit. It's very hard to get it into illiquid credit. But what we were very lucky in the first 2 transactions we did, took us through the sort of notional £1 billion mark. So we were £1.2 billion after our first 2 transactions, and that opened up a world of direct opportunities, effectively direct lending vehicles. And in fact, what we've done is we've set up our own what we call private markets vehicle. We're in the process of setting that up, which then allows us to take in illiquid assets from schemes. So we're able to deal with legacy assets that schemes have that may not be attractive to insurers, who have a plethora of opportunities for them and typically have their own bespoke strategies. What we can do is we can take in illiquid assets and then spread that risk across all of the schemes that we have. So we get the benefit of diversification of risk across all the schemes. Obviously, they have to be appropriately priced. We have to be comfortable that economically they make sense to us. But we're not under a matching adjustment regime, and we can be quite adaptable in what we do there. It does allow us to effectively create internal liquidity.
Mm-hmm.
So as schemes exit us and they go into the insurance market, they can realise their illiquid holdings, effectively sell them back to the other sections, and we can create that internal liquidity. That makes us flexible in how we deal with it, but B, it allows us to invest much longer term. So rather than investing.
Yeah, that's interesting, because again, going back to the DC market, it's interesting to me how many parallels there are with the DC market, because that was what Nest did very early on with their sort of real estate portfolio. And it was a similar idea, in that, you had real estate portfolio, and rather than somebody, when they reached their target date and retired, having to sell off that illiquid portion of the portfolio, they effectively just sell it back down to somebody who's much more junior. So it sounds like a sort of a similar idea. You're creating this own internal market, which does help to mitigate those liquidity problems and selling off assets that, just trying to fire sell them and getting the wrong prices for them.
Completely. It is another benefit of scale. If you've got a vibrant, growing business, then you can utilize that for the benefit of everybody.
Very interesting. So we haven't quite, so if we are 1.5, that allowed you to access direct credit. So when we get to 5 billion, what are you going to be able to do differently?
Well, as with all of these situations, we're not going to lurch into brand new asset classes. In fact, only last week we held a workshop with our trustees and our corporate and our external advisors to sort of get our heads around what the range of opportunities were to us. Could we take advantage of insurance-linked securities, as an example, or some funding arrangements? And they take a while, to be honest, because you have to make absolutely sure. We are investing on behalf of members. Not that we're slightly different to a DC scheme. The members don't see the pound for pound difference, but we are effectively investing to maximize their security. So we have to make absolutely sure that we really understand the risks and rewards involved in all of these. So I think what we would do is we will evolve. It will never be a revolution. We won't tip over 5 billion and say, now we're good for private equity. That won't be the situation. What we'll be doing is saying, what are we good at? What do we understand well? What are we rewarded for in the risk that we're taking? And what's what is the appropriate risk reward profile based on everything we know? And can we demonstrate to ourselves and then to other parties like the regulator that we really understand and are really tightly managing these risks? So it will evolve over time, and you do run out of opportunities, in the sense of you do want to diversify. You want to be in a situation where you spread the risk across all of the sections in a way that supports member security.
And maybe you have a slightly more limited investment universe than go back to the DC again, because as you said, you ring fence the assets for all of your schemes, but their ultimate goal is buyout. Is that correct? They're never going to, or they're just going to allow you to run on the scheme. So if you've got that very specific goal of buyout in mind, that's going to determine how you invest, because you have to invest in a way that either is very easy to transfer to an insurance company, or an insurance company with its much more prescribed regulatory regime is going to want to pick up on.
Well, that was initially what we thought we were going to do, was that you would effectively invest on behalf of one scheme and therefore transition the assets so that by the time it was ready for buyout, then ta-da, you'd have a matching adjustment ready portfolio to pass over to an insurer. What we found is that we can actually do better than that. Through this private markets vehicle, this internal private markets vehicle, we can generate a better return. And because we can recycle those assets, we can effectively give cash and gilts to the insurer at the end, as long as we've still got the flow of new business to new sections coming in that justify us being able to recycle. So as long as we keep balancing the books, we can actually invest on a longer term strategy. Now that does open up new asset classes. To your previous point, what about infrastructure debt? What about us we'd love to be part of the productive finance agenda. We genuinely would. As an aside, I think that when you remove the complexity of a pension scheme and the ongoing commitment, distraction and cost from a sponsor, you're allowing them to focus on their core business. And by definition, we are dealing with you. Therefore, I hope in a small way we're supporting the productive finance agenda through what we're doing in our day jobs. Yes,
it's kind of one step removed rather than you being able to do it directly because of the risk metrics of what you're doing. So what you were saying there, does the whole sort of investment model fall apart if you fail to keep getting in new money?
Not really, because there's such a long time lag that you're able to see it coming. So if, and we don't want to even think about this scenario, but if we were in a situation where we weren't attracting new schemes, we would have a long period by which we could run off our illiquid assets. So we'd have an alternative to just recycling. We would, proactively manage them and in the right way. That is the advantage of the pensions world, where you're making decisions over many years rather than we're not day traders by any means.
I hope not. So there's another little stat that somebody gave me the other day, that that we are taught as investment professionals, CAPM, the pricing of equity markets relative to bonds, and that the bonds market is stable and relaxed, and that's where we're going to get very little return because it's very unvolatile, and equities is the problem child that is volatile all over the top, and we want an equity premium for our risk relative to the bond market. And actually over the last few years, that relationship has been reversed, and actually it's been the equity market that's been less volatile and bonds that have been very volatile, because we've seen, to go back to our original news story of the week, we've now got this kind of we've got Trump involved in the debate that we've had over the last year about which direction, so early on, we figured out what direction the ECB was going to go in, and they started cutting interest rates. We figured out what the UK was going to go, but we still had this big question about the US Federal Reserve, and we continue to have this big question about the US Federal Reserve and where interest rates are going to go. So it doesn't look like now we've got Trump in the mix, along with potential clashes with the Federal Reserve and the market's view of the issue, that bond volatility is going to go away anytime soon. Do you think that's a fair assessment?
It's very hard to argue with that. And I know this is an investment focused podcast rather than a political one, but it's fascinating. If you go back to the original article, Donald Trump has done an incredible amount of activity in his first few days as his return to the administration. And it's very hard to separate out what's noise and what's real. Now, he's clearly putting down a marker with the Fed to say, look, I want lower interest rates. And in this devolved sort of decision making where the Fed are responsible effectively for inflation and he's responsible for growth, you've got this conflict. It's an age old conflict, and we have it in our country as well. He's not unintelligent. He understands the economics. He understands the trade-off. So at the same time he's berating the Fed for not cutting interest rates, he's also berating OPEC for oil prices, because he'd like them to bail him out of his inflation problem. Because if they've dropped the price of oil, his inflation comes down, he still gets his low interest rates, he gets his growth agenda, and he's happy. But you have got this tension, and it's very hard. I do think that we've got a lot of volatility politically, which feeds its way into the markets, because the markets they can't predict. And you look in our country, and it's a long time since Labour in power. People are finding it hard to remember, scratch their heads. Hang on, what did this bunch do? What are they? How reliable are they? And I think Rachel Reeves has taken an incredible amount of flack for the increase in interest rates, when actually we seem to have moved pretty much in line with other nations. So, like I say, it's a lot of noise around. It's quite hard to cut through and say fundamentally what's the outlook. I do think the outlook is for lower rates, but relatively slowly. I think there was an article that, following on from the one that we're focusing on from Goldman Sachs, or Goldman Sachs view, that was reported, where they think the market is understating how quickly interest rates have come down. So they obviously believe that Donald will get his way. And to quote him, he knows rates much better than the Fed and wants them to come down a lot.
I think what we've established really is just how unknowable, because I think financial markets, they really got a shock, and it was interesting being a journalist for as long as I have done. They really got a shock when geopolitical risk came back to the fore in 2016. Financial markets had gotten used to things being very predictable. Financial markets like risk, they like probabilities, they like being able to say there's a 1 in 10 chance, there's a 3 in 10 chance. What they're really bad about is uncertainty, and unfortunately human behavior is chock full of uncertainty, and when that starts to move financial markets, it's different. So I have seen, it's very interesting to observe how financial professionals have sort of approached that different attitude to financial uncertainty. And I wonder how, when you were at Clara-Pensions and you had kind of a shock, right, when interest rates corrected so rapidly and violently, that actually the people you thought were going to consolidate, they were like, oh no, we're fine now, we can go to buyout, and then you have to start the conversations again. So I wonder what insurance policies of your own that are LDI related are you pursuing to make sure that doesn't happen again, given the ongoing volatility, to make sure you've got enough conversations going along with enough different schemes to keep the assets rolling into Clara?
So, I mean, one of the human impact of this is, you're right about that. There is very much a human impact to this. It's very hard, with investors to say, I know we've been working on this for 3-4 years now, but actually our market's just disappeared. But we couldn't see it coming. There's no one to blame. Well, depends on your politics whether you do choose individuals to blame. And therefore, but we need to keep going because we're now engaged with a bit that you do need patient investors for that. And I think we were very lucky that we were able to get through that period. How do we make ourselves more resilient? It's having more conversations. We were we only completed the regulator's assessment to be a super fund in November 21. So we hadn't even reached our 1-year anniversary, and we had this situation that came up. More conversations. So we were engaging with a broader range of schemes, engaging with them before they reach the sweet spot for the Clara, which is typically in the range of around 85 to 95% of buyout funding. So we have found that we've engaged with schemes a lot earlier, so that they can be mentally on the journey a lot earlier. If you do get a correction in the same way again, those schemes might accelerate their thinking. We've extended our offering, so we've created new features of the Clara buyout model. It's still based very much on the same core principle. We're going to take things to buyout, but to the point about engaging with people earlier, we are developing a bridge to Clara model for those schemes that are below 85% funded on a buyout basis. And we don't have a balance sheet, though, which can hedge against those economic scenarios. So I wish we did, but unfortunately, that's probably one for further down the line.
So I wonder, going forward, what is the kind of, when we take a step back and we get a helicopter view of the whole market, the point really is we've got these really weird Pareto principles on steroids, I think it's fair to say, for the closed DB market, where I think there's a number like 1,000 schemes represent 95% of the assets. It's way beyond 80-20. But then you've got this huge number of smaller schemes with not that many assets in them. For you, what's the kind of the perfect vision of the future in 10 years' time? How do we tidy up this kind of long tail of teeny tiny schemes? Where would we like to be in, say, 5 to 10 years' time?
So the schemes that are funded enough to go to buyout should go to buyout as quickly as they can. And a lot of the insurers are now offering streamlined processes to facilitate this. And you've also got specialist brokers, happy to work with the smaller schemes and facilitate that journey. That should happen. That would sort of be unforgivable. It doesn't make sense for that cost and distraction to be ongoing. And fundamentally, it's about the members having their benefits secured in full is a great outcome. Now, for those that aren't at buyout level, we would love to develop a streamlined proposition so they can come to Clara. We are on the verge of announcing a relatively smaller transaction to show that, our first transactions were pretty chunky, 600 and 250, that order of magnitude. Where we'd like to be is, can we come up with a solution that allows people to, again, share in those benefits of scale and secure the member benefits earlier? That we're working very hard on that. That might be a couple of years away, simply because it's hard to make the economics work. But if we can follow in the footsteps of the insurers and make sure that we've got a streamlined process that makes sense for everybody, then that's where I'd like us to be. Well,
I think that's a great place for us to end this podcast. I think we've covered an enormous amount of material in just under half an hour, Simon. We've had lots of speculation about future direction of interest rates. We've had a good canter through your investment allocation, your personal experience of the rapid, the U-shaped valley of interest rates, down, flat, and then straight back up again, and what that meant for you at Clara. So all I can say is thank you so much for being such a fascinating guest on the podcast. It's really been great having you here. Listeners.
Well, thank you very much for the opportunity, Charlotte. It's been great fun.
And listeners, if you want to make sure that you never miss an episode in this series or future series, then make sure you hit the subscribe button. If you're listening or watching this on Spotify, then there'll be a poll below for you to fill in. So please do engage and feel free to leave your comments on whatever platform you consume this podcast. Thank you for listening.